Yes, good evening class. Welcome for today's lecture. So today we are going to look at the financial statement. So the financial statement and the financial statements are essential tools for understanding the financial health and performance of a business. So the financial statements, they provide structure and standardized way to present financial information, facilitating transparency, accountability, and helping the business to make informed decisions. So a financial statement is a formal record of the financial activities and position of a business, person, or other activities. So these statements, they provide a summary of how the business is performing and it also how the stakeholder, and it is also used by the stakeholders. So these stakeholders can be we have the investors, we have the creditors, and we also have the management, which will help them to make informed decisions. So the financial the financial statements, they involve theory. We have the income statement, we have the balance sheet, and then we also have the statement of cash flow. So let's look at the income statement. The income statement, it can also be called income, it can also be called profit and loss. So under this it shows the company's financial performance over a specific period, which is detailing the revenues, the expenses, and then the profit or losses. So this income statement, it helps the business to know whether the business is making loss or it is making a profit. So when you come up with an income statement, and then you will be able to know the status of your business. So income statement here, it is very crucial in any business or in any organization. So let's look at the key components. Here they include, we have the revenue, which is the income earned from the sales of goods or services. And then we have the expenses. These are costs incurred in the process of earning revenue. For example, we have cost of goods sold, we have the operating expenses, and then we also have the net income, which is the difference between total revenue and total expenses, representing profit or loss. So let's look at one example. We are given our sales revenue. We are going to look at some simple example. So we are given our sales revenue, which is 200, and then we are also given the cost of goods sold, which is 120, and then we are also given our operating expenses. So we need to construct our income statement. We need to know whether the business is making a profit or whether it is making loss. So what we do, we come up with a table. We are going to come to insert, and then we insert our table. So table, let me take 2 columns. So I need 5, and then here I'm going to put our revenues. This should be our revenues, and then this one should be the amount. So we have the sales. We are given our sales revenue. the amount which is given to us, our sales revenue, is 200. So we are going to put here 200. $200,000. And then we have cost of goods sold, which is 120. So we need to determine the gross profit. Gross profit. So we determine the gross profit by subtracting our sales revenue from the cost of goods. So when you subtract 200 minus 120, we get 80,000. And then we have our amount here. We should put in dollar from bracket dollar. Yeah. So we have, let's put our operating expenses. Which were given our operating expenses are 30. So they are $30. 30. So let's tabulate our let's do our net. We come up with our net income. So to determine whether it is net income or net loss, we need to first net income. So we need to first calculate, and we say, so by getting our net income or net loss, we get the gross profit minus our operating expenses. So when we subtract, it will give us 50,000. So it means it's a positive answer. So it means our gross profit here, which means here we made net income, net profit. So this is how we tabulate income statement. So let's look at the balance sheet. So balance sheet, this statement provides a snapshot of company's assets, liabilities, and shareholders' equity at a specific point in a time. So this one, balance sheet, it has an equation which says assets is equals to liabilities plus shareholders' equity. So in your business, your assets should be, when your total assets should be equal to the liabilities and the shareholders' equity. So what are assets? So assets are resources owned by the company. For example, we have cash, we have inventory, we have property, and many others. And then we have liabilities. So liabilities, these are the obligations owed to the outsiders. All these are the obligations of the company. So for example, we have the loans we have accounts payable. The accounts payable, they are also the same as the creditor. And then we have the bank overdraft. So those are some of the examples of liability. So shareholders' equity, this is the residual interest in the assets of the entity after deducting liability or attendance, which can be the capital. We can also call shareholders, which can be the capital. So the example, we have the common stock, we have the retained earnings. We have the retained earnings. So let's look at an example. You're given your cash. You're given cash of 50, accounts payable of 20, accounts receivable of 30, long-term debits, inventory, and we have property plant equipment, which is 100, and then we also have shareholders equity, which is 150,000. So before coming up with our balance sheet, we need to identify the assets. We need to categorize the assets, we need to categorize the liabilities, and also we need to identify the shareholders equity. So let's put a table. So let's put a table. Come to insert. 1, 2, 3, 4, 5, 6, 7. So here we have our assets. Here let's put our amount, and then here let's put our liabilities. And then here we put our amount. So we are given the cash. Cash falls under assets. We are given the cash of 50. And then we have accounts receivable. Accounts receivable are the same as debtors. Accounts receivable. We are given $30. Let's put our dollar sign up here. So, and then we have our inventory. Our inventory, it's 40,000. And then we have property. Plant and equipment. Which is 100,000. So let's calculate our total assets. Total assets. So when you add 50 plus 30 plus 40 plus 100, which will give us 120,000. So let's come and identify our liabilities. We have the accounts payable, which were given 20. We also have long-term debt, which is were given as 50,000, and then our total liabilities. Total liabilities are 70. So let's calculate our shareholders equity. Which we are given as 150. So when we get the total, when you add, you get the total of this total here was 220. So when we add, we get the total of 220. So when we add liability and our shareholders, it gives us 220. So it means here our assets are equals to liability plus the shareholders. So that's how balance sheet is supposed to be. Alright. Then let's look at the cash flow statement. So the cash flow statement, this statement provides a summary of the company's cash flows, cash inflows and outflows over a period of time. So it is categorized into three. We have the operating, investing, financing activities. We have the operating, investing and financing activities. So this help to access the company's liquidity and cash management. So the operating activities, these cash flows, they are from the core business operations. So the investing activities, these cash flows are from buying and selling assets. And then we have the financing activities. These are cash flows from transaction with the company's owners and creditors. So let's look at an example. We are given the net income adjustment for non-cash items. We have the decrease in working capital, purchase of equipment, proceeds from issuing shares. Then we have the repayment of long-term debt. So we need to know our cash flows. So we shall come up with our table. We come to insert the table. So this one, it will involve 2 columns, 2 rows, 2 columns. Let's insert the table. Let me just put 2 here. So here we need to identify which ones are falling under operating activities, investing activities, and as well as we need to know our financing activities. So let's start with our cash flows. Cash flows from operating activities. So here we are going to be putting the amount in dollar. So one, we have our net income, which we are given the amount as 50,000. It's 50,000. Then we have our next, we have adjustments for the non-cash items. So here we are given $10,000. So we have changes. In working capital. So if our working capital change, it means it has reduced. So we subtract. So if it is any reduction in our money, so it means the money is going out, which is cash outflow. So we need to subtract. So which here, instead of putting a negative in accounting, we use bracket. So bracket, it will represent our subtractions. So we have the 5, it was 5,000. 5,000. So we are getting our net cash from operating activities. So when we add 5,000, 50,000 plus 10,000 minus 5,000, which will give us 55,000. So our net cash from operating activities are 55,000. So let's look at cash flows. Let's look at cash flows from our investing activities. So under we are given our purchase of equipment, purchases of equipment, which is we are given the amount is 20. So since we don't have any other operating activities, so when you purchase an equipment, it means we have cash outflow, so it is a negative. So we'll put bracket. So it means it is reducing our cash flow, which is the cash outflow. So we have here 20, the total 20,000. This is the net cash flow from investing activities. So let's look at our last cash flows from financing activities. So we have one proceeds from issuing shares. The amount we are given 30. And then we have repayment of long-term debts. So repayment, we are paying, it means our cash is going out. So here when you issue proceeds, it means proceeds from issuing shares. It means here it is the profit that you get from your issuing, the money, cash that you've gotten from your issuing of shares. So it means the income is coming into your business. But then here we are repaying the long-term loan. It means our money is going out. So when the money is going out, it means it's reducing our cash. So it means it is cash outflow. So when it is cash outflow, that is a subtraction, which is reducing. So we are going to use a negative. It is a negative, we subtract. So it means here we put into bracket 15,000, we close. Okay. So when we subtract 30 minus 15, we get 15. We get 15,000. 15,000. So to get our, there we have gotten our net cash flows from financing activities. Financing activities. So here we need to know our, then we are getting to know our net income, our net capital, the money that the total cash flows. So here we are getting our net cash flows. So our net cash flows, we are going to add our cash flows from the operating activities, cash flows from the investing activities, and then the cash flow from our financing activities. So if you add, you'll be able to get our net, whether we have the net cash flows or we have the inflows. So it is positive, we have the inflows, it is more than the cash outflows. So let's look at the importance of financial statement. What are the importance of financial statements? So one, we have decision making. So here it helps the investors and managers to use financial statements, which will help them to make the informed decisions about investments, resource allocations, and also strategic planning. So we have also performance measurements. So this provides a historical record of the company's financial performance, which will help to assess profitability, efficiency, and also financial health. So we have compliance. So the financial statements, they ensure compliance with inventory, with regulatory requirements and accounting standards. So we have transparency and trust. So financial statements, they promote transparency and they build trust with shareholders. This can be done by providing a clear and accurate picture of the company's financial positions and performance. So what are some of the limitations? Some of the limitations of financial analysis. One, we have financial analysis are based on historical data and may not predict future performance. So you find that here we cannot predict the future, since we based on the we based on a historical data. So when you're coming up with a financial statement, it means your records have been recorded. You first record your records down, and then that's when you can be able to come up with your financial statement. So you may find that this may not predict the future performance, since we only take things that has happened. And then we have accounting policies can vary between companies making comparison challenging. And then we also have, you may find that we have a potential for manipulation of financial statement through accounting practices. Let's look at the ratio analysis for financial performance. Ratio analysis, we have financial statements. They offer a wealth of information, and interpreting raw numbers can be challenging. And then we also have ratio analysis. They unlock deeper insight by comparing key financial metrics. And then we also in this presentation we shall explore the different types of ratio used to evaluate a company's financial performance. So this financial statement can be analyzed using various financial ratios to assess different aspects of company's performance. So these are some of the ratios. We have liquidity ratios, which is measured by the company's ability to meet the short-term obligations. So it is given by current ratio is equals to current assets. We divide by current liabilities to be able to get your current ratio. And then when you want to compute your quick ratio, or it can be called acid test ratio, it is given by current assets minus inventory. You divide by your current liabilities. And then we have profitability ratio, which help to evaluate the company's ability to generate profit. So we have the margin. We have one method of computing profitability ratio. We have margin. We have gross margin. So gross margin, it is given by gross profit divided by revenue times 100. So we have our net profit margin. It is given by net income divided by revenue times 100. And then we also have return on assets, which is given by in abbreviation it is ORA, which is given by net income divided by total assets times 100. So we also have return on equity, which is abbreviated as ROE, which is given by net income divided by shareholders' equity times 100. And then we also have the efficiency ratio, which is used to assess how effectively the company utilizes its assets. So under it we can use the following methods, which are inventory turnover. So the inventory turnover, it's given by cost of goods sold divided by average inventory. And then we also have account receivable turnover, which is given by net credit sales divided by average accounts receivable. And then we also have leverage ratios, which help to measure the extent of a company's financial leverage. So it is given by debt to equity ratio, which is calculated as total liabilities divided by shareholders' equity. And then we also have interest coverage ratio, which is given by earnings before interest and tax divided by interest expenses. So if you're coming up with a leverage, if you want to calculate the leverage ratio, you need to know the following methods that you can use. So these ones, in case in your organization you want to measure the extent of a company financial ratio, then you can come up, you may use debit to equity ratio or the interest coverage ratio. And then let's look at using financial statements for analysis. So we can use the financial ratio for analysis in the following. So one, we have trend analysis, which is reviewing financial statements over multiple periods. It can reveal trends in revenue growth, expense management, and also profitability. So we have the benchmark. The benchmark also it's comparing financial ratios and performance metrics against industry standards or key competitors, and also it helps the competitors gauge to relative performance. So we have forecasting and planning. So by this, the historical financial data, it is used to create financial forecasts and also budgets, which will help in aiding strategic planning and decision making. So we have a risk assessment. So here, by analyzing financial statements, it helps to identify the potential risk. Those potential risks can be the high debt levels or declining profits margins, which will allow for proactive risk management. So let's look at the regulatory requirement and standards in financial statement. So these financial statements must comply with various regulatory requirements and accounting standards. Those accounting standards can be generally accepted accounting principle, which is the set of accounting standards used primarily in the United States. And then we also have the International Financial Reporting Standards, which is IFRS, a global set of accounting standards used in many countries outside the United States. And then we also have the Sarbanes-Oxley Act, which SOX, U.S. legislation aimed at providing corporate governance and also accountability, particularly for publicly traded companies. So this is usually used in publicly traded companies. So thank you. That is it for today's presentation. Let's look at in our next presentation.